Okay, let's enlarge screen. Global business. Reasons for international trade, the exchange rate, international trade policies, multinational enterprises, and outsourcing. Managerial problem. Business is global. Wet and Rolls-Royce cars are examples of it. How does the price of wet or Rolls-Royce change in response to a change in exchange rates? Does the change depend on the competitiveness of the market? We need to examine why firms and countries participate in international trade and show how trade policies about taxes affects managerial decision on investment. Empirical methods. International trade depends on a comparative advantage and prices affected by exchange rates. Trade policies include tariffs and quotas to restrict imports and subsidies to encourage exports. Differential in taxes, exchange rates, and outsourcing conditions affect multinational enterprises' investment decisions. International trade allows countries to specialize in the products they have comparative advantage, the ability to produce at lower opportunity costs than other countries. Suppose that US and Japan not trade, and each country is in a competitive equilibrium. The US produces and sells a bag of rice for $1 and silk scarf for $10. So 10 rice bags is one scarf. Japan produces and sells a bag of rice for 200 yens and the scarf for 1,000. 5 rice bag, one scarf. The opportunity cost of scarves is lower in Japan, and the opportunity of rice is lower in US. So the US has a comparative advantage in producing rice, and Japan has it in producing scarves. In the absence of transportation costs, both countries could gain if the US shipped rice to Japan and Japan shipped scarves to US. If the US produced one scarf less and 10 rice bags more, and Japan 5 rice bags less than one extra, both countries could produce the same number of scarves and have 5 extra bags of rice. Intra-firm trade, a single firm is on both sides of an international trade. It exports the output from its operation in one country to an affiliated business unit in another country. About 1/3 of world trade is intra-firm trade. So General Electric has production facilities in Hungary and Romania to produce a refrigerator. General Electric must manufacture the basic parts and assemble those parts into a finished product. A Hungarian worker has absolute advantage over a Romanian one. He can produce parts for 4 refrigerators or assemble 4 per day. A Romanian worker can only produce parts for 2 refrigerators or assemble 1 refrigerator. So the General Electric can take advantage of intra-firm trade to reduce costs and maximize profits. The Romanian plant should assemble refrigerators and the Hungarian plant should manufacture parts. Then we have increasing returns to scale. Increasing returns to scale production function if all inputs are doubled, the resulting out more than doubles. Thus, all else the same, it is less costly having one IRS plant produce a given amount without than spreading the production of all 2 IRS plants. Country size relatively small um, countries may benefit from taking advantage of returns to scale. Consider Canada, whose population and GDP is 1/10 of the US. Without international trade, Canada would not cost effectively produce and consume commercial jet aircraft, which are produced with substantial returns of scale. With international trade, Canadian Bombardier, which is the third largest world commercial jet producer, Canada exports light commercial jets and imports large commercial jets produced by Boeing and Airbus. The more varieties of a product in the market, the fewer the units of any one variety a firm can sell. A toy industry produces an incredible variety of products and adds new varieties every year. The only practical way to take advantage is for a firm to sell its product in many countries. Now, those examples don't take into consideration tax and tax barriers for certain imports. For example, if Canada requires high taxes for large aircrafts like Boeing and Airbus, then importing it would not be so, let's say, efficient to import. Or the US imposes high taxes for importing Canadian small aircrafts. That would not. The same with this Brexit in Europe. A trade war can emerge because the European authorities can require high taxes for, let's say, UK products imported in Europe, and the same, the UK can require taxes for the European. And this can create at a certain level losses for both parties. However, to a certain point, UK can, in the short term, UK can incur higher losses because it's a smaller, let's say, a region as compared to the Euro area and to the European Union. And considering the fact that many plants, UK plants are depend on imports from European Union, that could be a problem. An exchange rate is the price of one currency, such as the euro, in terms of another currency, such as the dollar. The euro is the currency of 23 European countries that belong to the Eurozone. It can be traded for US dollars, Japanese yen, British pound, or many other currencies. Because currencies is exchanging, comparing market, we can use the familiar supply and demand model to the exchange rate. The demand curve slopes down because the quantity of euros demand Americans increases. Okay, now let's write some ideas about the exchange rate. We have here, let me share my screen. Okay, the exchange rate. Theories. And I will be presenting the purchasing power parity, or 3Ps theory, first mentioned by Salamanca School in 16th century. Let's say if an example assumes that countries produce only one type of product there are no transaction costs, transport costs and taxes assumed. So if US produces let's say 20 units, and let's say if US produces 70 units and India only 1 unit of the same product, then USD Indian rupiah is 70. So 1 USD is 70 Indian rupiahs. So the country that produces more goods and services will have a higher, a stronger currency. Now, countries produce different types of products and services. There are transport costs, taxes, and so on. There is speculation on the foreign exchange. So this theory is too simple to Purchase Power Party says the law of one price. The law of one price in the long term. So all prices in all countries will be equal in the long term. Now, this is not happening because prices in India and America are completely different. Generally, developed markets like US have much higher prices for all products as compared to developing and poor markets, because there's also a higher standard of living, higher wages, and also higher demand means higher prices. So we can write this idea. So generally, developed markets have much higher prices than poor and emerging markets due to higher wages, higher demand, more liquidity and wealth in the economy. Now, the law of one price, one price may be true in euro area. Maybe true in euro area to a certain extent only. So to a certain extent. For example, it was noticed in different research papers that when countries joined the euro area, the domestic prices in a specific country tended to come closer to the average euro area prices. and especially in smaller countries, smaller developing countries. That's why one of the disadvantages of the addition of the joining euro area is the fact that prices will get close to the euro area average, while wages will will not keep the pace with price increase. So the purchasing power, the purchasing power will decrease. Factors that influence factors that influence FX evolution: economic growth, difference in interest rate evolution between the two countries, and we have uncovered interest parity, difference in labor productivity, difference in inflation rates, and we have the purchasing power parity. Let me mute because we okay, let me mute one of your colleagues because it's so difference in inflation rates, trade balance evolution, trade balance, budget deficit, central bank policy, government policy, market psychology, speculative attacks, and so on. Speculative attacks were in 1992, 1993, where when Soros funds attacked different currencies, and that was the time when most central banks realized they cannot keep the FX pegged. So from now on, they left currencies fluctuate free. However, it's not a completely free movement. It's a managed floating because when at a certain level, central bank intervenes in the foreign exchange market not to have too much volatility, because this is creating a journey for investors, for people that are dealing with importing and exporting products, foreign trade, and so on. Let's go back to our okay. Exchange rate is the price of one currency, such as the euro, in terms of another currency, such as dollar. The euro is the currency of 23 European countries that belong to the Eurozone. I think this is changed now. Let me take a look to the euro area number of countries. Consists of euro area consists, according to Fred, consists of 19 countries that use the euro. The latest countries that joined euro area being Estonia, Latvia, and Lithuania, the Baltic countries, the small. So 19 countries. It's mistake here with the 23. So Austria, Lithuania. So Lithuania adopted the euro in 2015, Latvia 2014. So we have recent yes, what is this is trying to say is that there are also other countries that, so for Kosovo and Montenegro officially adopted the euro as their sole currency without an agreement. So adopted, but those countries are not considered part of the eurozone by European Central Bank. Okay. Now, other countries like Romania, it says Romania, Poland, Czech Republic, Bulgaria were said to join soon euro area by 2011 euro area. However, this is still not happened even after 10 years, because after the public debt crisis in euro area and because of some small countries had problems like Greece and Portugal due to their lack of competitiveness, accessing the euro area or even the desire of smaller developing countries to access the euro area has lowered. They will not enter euro area until they have completely, they are highly competitive and prepared. Okay. Let me gains international trade. So if exchange rate for the euro for US consumers and firms increase their demand for European goods, more goods for a given number of dollars, the demand for European consumer and firms. Managing exchange rate risk. Individual firms that operate in many countries bear the risk that the exchange rates move in unexpected directions that may negatively affect profits because of macroeconomic or political factors. Reducing risk. A firm may transfer all risk to the other party by imposing the transaction in the firm's own currency. Hedging risk. A firm may buy a forward contract or a futures contract at a fixed price. The Chicago Mercantile Exchange is the largest futures market in the US. Historically, the governments have concentrated on restricting imports rather than limiting or encouraging exports. So we focus on the effects of trade policies that restrict imports on prices, government revenue, and total surplus in a competitive domestic market. A government can choose one of four import policies: allow free trade. So foreign firms may sell in the importing country without restriction. Ban all imports. The government sets a quota of 0 imports. Set a tariff. The government imposes a tariff of imported goods. Set a positive quota. The government limits imports to a determined level. The next slides, we compare the effects of all these import policies by examining the US market for crude oil. We assume that transportation costs are zero and the US is small enough to be a price taker in the world. So the supply curve of oil is horizontal at the world price. So we have here a chart. If tariffs and quotas harm the important country, why do governments impose trade barriers? It pays for producers to organize and lobby the government to enact these trade policies because there are large individual potential gains on consumers as a whole suffer large losses, but the loss to any other consumer is usually small. So firms in rent-seeking activities, rent-seeking efforts and expenditure to gain a rent or a profit from government actions. Lopez and Pagulottos estimate the deadweight loss and the additional loss due to rent-seeking activity in the US in food and tobacco was 7.8 billion. In dairy price, sugar man, the loss to consumers was 84.8 billion. Producer gained 64.44 billion. The government collected 2.2 billion. The deadweight loss was 17.8 billion. Non-competitive reasons for trade policy. A government intervenes in international trade for many reasons beyond raising revenues from tariffs or selling quotas. The three most common reasons for restricting international trade are creating market power, strategic trade policy, and contingent protection. The government can drive the price to a monopoly level by using tariffs or quotas, even if the underlying industry is highly competitive. The Philippines supply 4/5 of the world coconut oil, but the international price was competitive because its growers, refiners, export operate in competitive markets. The government imposed an export tax that increased the world price and allowed the government to capture the increased profit as tariff revenue. The government could have achieved the same outcome by limiting exports using quotas that it would sell to the highest bidder. The government, so two major vaccine producer, Ajinomoto, Japan, Novartis, Swiss, choose whether to enter produce a particular vaccine for the US market. So in table 17.3, there are two purely Nash equilibra. Novartis enter while Ajinomoto stays out, or Ajinomoto enters the Novartis. If only the Japanese guy offers a $10 subsidy to Ajinomoto, the profit matrix changes. Now Ajinomoto has a dominant strategy and Nash equilibrium is Ajinomoto enters and earns 100, Novartis stay out. Policies that create market power and beggar tie neighbor policies. So drug entry with a subsidy. In this case, Novartis will have a loss of 5 million if enters. Not enter 0. Not enter, no. If Ajinomoto does not enter the market, 0 profit. If Novartis enter 90, and so on. Contingent protection. Contingent protection is a trade policy that protects domestic producers from certain actions by foreign firms or government. Many countries have contingent protection law against dumping. A foreign producer sells a product at a price that is lower than its cost of production. Under its anti-dumping law, the US imposed a tariff or duty on the dumped good. The justification of this law is to prevent foreign firms from predation, keeping its US price low until it drives US firms out of the industry and then raising its US price. Critics of free trade raise concerns about environmental, wage, and labor standards. They predict the developing countries may become pollution heavens and manufacturing infernos. However, the Mexican exchange after NAFTA indicates neither notable increase or decrease in environmental problems. There's no evidence of general labor standard deterioration either. Multinational enterprises. Multinational enterprises normally have a parent company and a number of foreign affiliates with their own CEOs. An affiliate is a company in which parent has at least 10% of ownership. If the ownership is 50% or more, it's called a subsidiary. Each subsidiary normally has discretion over business decisions, such as how much to produce, what prices to charge, and how much and where to advertise. Okay, and we have here outsourcing. International outsourcing, where firms buys goods and services from foreign suppliers that the firm would otherwise provide internally, is controversial and sometimes subject to consumer boycott. However, it is less controversial than domestic outsourcing. All firms outsource in some degree. While the debate rages in the United States about jobs moving to India and other foreign countries, Europeans are protesting that high-paying research and development jobs are being outsourced to the United States from Europe. Insourcing. Free trade includes outsourcing and based on comparative advantages implies that some people gain and some people lose. Firms in non-competitive sector may lose sunk capital. Their workers may suffer from at least temporary unemployment. The gains in the other sector are large enough to compensate the losers. However, if society fails to compensate, they will be adamantly opposed to free trade. The US spends only 0.5% of its GDP assisting displaced workers, compared to 0.9% UK, to 3.1% Germany, and 3.7% Denmark, according to Farrell, 2006. How does the price of wheat or Rolls-Royce change in response to a change in exchange rates? Share my screen. Go back here. So let's make an. So we were at exercise 1. So this is in bold. Exercise 2. So exercise 3. Exercise 3. The US Japanese yen is 110 Japanese yen per dollar currently. So forecasted US inflation the forecasted US inflation Okay, from trading economics, let me share screen in October 2021. Forecast US inflation for 2022. No, it's not. Forecast omitted to forecast 22 5-year. I'm searching on. No, it's not provided here. OECD data. So it's no. Let's take a hypothetical value. Let's see if Statistica provided the US inflation forecast. Yes, it's allowed. It's 222 is 2.4. So let's copy this chart so that we have in. I don't manage to copy it for one reason. Okay, copy. Nah. So the forecasted US inflation for 2022 is 2.4%. Japan inflation. For 2022, Bank of Japan here. Let's Japan. Okay, Statistica. '22 is 0.7%. Forecasted Japan inflation for 2022 is 0.7%. The first question is to identify which currency is expected to appreciate in 2022, considering purchasing power parity. So this is the first question. Considering US inflation is higher than Japan inflation, USD dollar is expected to depreciate versus Japanese yen. calculate the expected evolution of USD Japanese yen. Okay. The expected evolution, so it's the difference. So here I would put here 0.024 and 0.007 minus. So USD is expected to depreciate by 1.7% as compared to Japanese yen. Okay. Now, this is 2022. I said we have those values. And put forecast here F. 2023 F. Let's assume 2%, Japan 1%. 2024 1.909 US inflation. Let's put here inflation in US and Japan. Annual, put here annual rate. Annual rate. Okay, now let's save the file. Okay. Let's put those in percentage. Now, cumulative inflation. Cumulative inflation. Cumulative inflation is 1 plus 2.40 multiplied by 1 plus 2 multiplied by 1 plus 19 and so on. So it's a minus 1. Oh, so much? No, this is not. It's a 1.9%. And this is minus 1 and getting percentage. The same here. So the cumulative inflation, so format cells, percentage. Yes, okay. So cumulative inflation is 6.43% in US and 2.62 in. So USD is expected to depreciate by the difference in 2024 vs 2021 as compared to Japanese yen. So this is according to purchasing power parity. Now this was exercise 3. Let's put exercise 4. For a manager has a portfolio of $1 million, and it's $1 million. Portfolio volatility or risk is 1%. 1%. Calculate the maximum expected loss in 1 day period using a value at risk or VAR approach. So portfolio value we have here, which is 1 million. Risk is 1% and Z with a probability of 99% is 2.333. So the maximum expected loss in 1 day time is just the product of all those. Multiply. Okay, in dollars, and we put this in dollars. Format cells. Okay. The maximum expected loss, after 5 days is the same. So it's the product of all this multiplied by S squared T of the number of days, 5. So it's okay. Okay. So this was with the valued risk and how we can calculate the maximum expected loss. This was exercise 4. Now let's make exercise 5. Exercise 5. An investor has $100,000 and decides to convert this amount in Japanese yen. Calculate the current value of Japanese considering USD is currently 110. So current value is 11 million Japanese yen. After 3 months, USD Japanese yen is 105, and the investor converts the amount, the sum again in USD. Calculate the profit or loss. So it's so let's put the new currency. So the amount USD amount would be converting. So this divided by 105, so it means 104,762. USD. So the profit would be so profit is generated because of the appreciation of Japanese yen versus dollar. Calculate the return. Calculate the 3 months. Calculate the 3 months return. So it's divided by, okay, calculate the 1 year return if we assume in each quarter or 3 months the investor obtained the same return, 0.6%. The formula is so the annual return in this case would be 1 plus 476 at 4 minus 1. So it's 20.44. Okay, percent, the annual return. So we have done some exercises with the FX evolution, with appreciation, depreciation of a certain currency, value at risk,